Today, we continue that journey focusing on growth with purpose, sustainability, and India's demographic future. Now, to begin the day 2 and set the context for our exciting lineup of discussions ahead, may I please invite on stage Sri Ashwini Kumar Tiwari, Managing Director CBNS at the State Bank of India, for the welcome remarks. Ladies and gentlemen, please give him a huge round of applause.
Respected Governor RBI, Shri Sanjay Malhotra ji, Chairman SBI Shri Setty, my colleague Shri Rana, Managing Director, members of the board, other staff from SBI, our guests, many of whom would join us in the panels to follow. Ladies and gentlemen, good morning. This is the second day of the 12th SBI Banking and Economic Conclave, and we resume from where we left yesterday. The evening performance of the breathless but breathtaking performance by Shri Shankar Mahadevan, probably still fresh, and the events are moving at a real fast pace. Just to give a little bit of a recap, I know Saloni did it yesterday, but for those who were not there, we had the gracious presence of the Honorable Finance Minister, and who had very graciously come only for this session. So we again thank her. And her inaugural address shed the light on future path towards self-reliance in an increasingly fragmented world. And she talked about the concept of self-reliance or Atmanirbharta, which she clarified is not isolationism, it is essentially a active participation in global value chains, developing homegrown solutions and technology or otherwise, and that work for not only domestic problems, but also for global countries and people. And she acknowledged the role of banks in the financial self-reliance, which is part of economic self-reliance. She, in the end, also exhorted the banks to keep the physical touch along with the digital, have a local connect with special focus on using local language, vernacular for serving customers, and also said that banks must further support MSME. They've done so, but more support is required. This was followed by a very interesting CEO panel, which had a large variety of CEOs, ranging from Anish Shah, the head of the conglomerate Mahindra Group, who talked about his ambition to have his company amongst the 50 most admired companies. Even after he was pushed to give some numbers to that, he resisted the idea but said, this is what we want to lead with a sense of purpose. We also had Mr. Vikas Kaushal, the HPCL chairman, who talked about the investments HPCL is making and the challenges which have come with the sanctions in the crude oil space. Dipali Goenka, representing Welspun, again talked about the textile industry, which again has challenges in terms of the sanctions, rather tariffs, which have been imposed. Dr. Praveer Sinha from Tata Power talked about the fact that India is in a really sweet spot as far as renewable energy is concerned, and we should be able to achieve the targets which are set in very, very seamlessly. We also had Upasana Taku, who leads MobiKwik, a fintech, and this was a completely different lens, versus growth versus the need for cybersecurity and keeping customers safe. And finally, we had R. Dinesh, who leads the logistics company, TVS, and therefore he talked about from a TVS, working on logistics, which is currently very fragmented. After this panel, we had the keynote address by Shri Tuhin Kanta Pandey, the chairman of SEBI, who pointed out that the trend for household savings to move to investment is a secular trend, and he gave some numbers to show this. For example, from 2019, the number of unique investors have moved up from 38 million to 135 million in 2025, and similarly, mutual fund unique investors have moved up from 10 to 56 in this same period. And the rate of growth of mutual funds and securities in these 5-6 years is at a CAGR of 24% versus bank deposit growth of 9%. So this is something we have to recognize and then work accordingly. And if this is the trend, then how do SEBI and the different regulators, including us at banks, keep the customers safe and have customer education as a key element of having a proper asset allocation? And this was followed by a talk by Shri M. Nagaraju, Secretary, Department of Financial Services, who shared his valuable insights on a number of subjects such as the requirement of a double-digit credit growth for achieving Viksit Bharat. He talked about 13.3% credit growth for a 22-year period. And thankfully, the banks are getting there, and therefore we expect that we should be able to measure up. He also asked banks to continue to support MSMEs, agriculture, education loans, and said that the service in the branches must continue to be better and consistent. And this was the day yesterday, followed by Shankar Mahadevan's performance, as I mentioned, and today's proceedings. We have a beginning with a keynote address by the Governor RBI, Shri Sanjay Malhotra, and we look forward to hearing you from sir, and followed by a unique family business panel, which will talk about scaling with purpose. So this has been a unique feature since the last two editions of this event, where we are calling younger heirs or those who will lead the companies in future and trying to understand what their thoughts and their vision is for the companies. This will be followed by a green panel, which will take up the issue of sustainable opportunities and how do we achieve self-reliance here, and also achieve our national commitments towards the climate change, despite the fact that the external environment is not so conducive today. And followed by a post-lunch session, we'll have two special addresses by the Deputy Governor RBI, Shri T. Ravi Shankar, and this would be followed by an economist panel, which has a very interesting topic, which is, will India get older before it gets richer? I have to compliment Dr. Ghosh for being a little provocative here, but we hope to see some good views expressed here. And the last special address will come from Dr. V. Anant Nageshwaran, the Chief Economic Advisor to the Government of India, who will talk about his views on Indian economy, the views of the economy growth in the foreseeable future, and again, how we can achieve self-reliance. The policy perspective coming from him will be of interest to many in the audience. So I hope the audience will find all these topics interesting, informative, and use these key takeaways to fine-tune things back home. And let me now take the opportunity to welcome Shri Sanjay Malhotra, Governor RBI, to deliver the keynote address and set in motion the second day of the 12th SBI Banking and Finance Conclave. Thank you.
Chairperson SBI, Mr. Setty, MDs, members of the board of SBI, esteemed industry leaders from the banking and finance world, media, ladies and gentlemen. I'm delighted to be here, as always, in this SBI Banking and Economic Conclave. I thank the chairperson, SBI, and the whole SBI family for giving me this opportunity to be here. This conclave comes at a time when there are unprecedented uncertainties, geopolitical tensions, technological disruption, and so this is very timely. It affords us with an opportunity to dwell on what the challenges are, and at the same time, what this offers to us, more importantly, I would say, in terms of the opportunities. I recall about a year ago when I spoke at this particular conclave virtually from North Block. I talked about the reforms that we carried on in the taxation sector. And today I stand here before all of you to talk about some of the regulatory changes that we have brought out in the last few months. You are aware that earlier we had issued a regulation-making framework for RBI, in which we have a consultative process. We are trying to make it more open, more consultative, more data-driven, more evidence-driven. And so we do a consultation, a public consultation, which has been formalized in the framework. We set out the objectives of the regulations, and we do an impact analysis. So in line with the same spirit which has been given there in the framework, I propose today to shed some more light on the objectives and the rationale for some of the important measures that we have taken in the last few months. To set the context, I would like to reiterate what I said in my first MPC statement in February this year, and whatever we have done in these past few months, including the last MPC statement, is in line and consistent with what I had said in my first MPC statement. I would reiterate that, and I had said that the interest of the national economy demands financial stability. For us in the Reserve Bank, this is the guiding principle. This is the North Star, because short-term growth, which is achieved at the cost of financial stability, can have bigger consequences for longer-term growth. Research shows that financial instability may not only more than offset the gains of short-term accelerated growth, but may also make recovery more distressful and longer. At the same time, economic interest warrants increasing efficiency and promoting innovation, which also is the duty of RBI. We recognize that just like there are no free lunches, regulation to enhance stability too is not devoid of costs. There are trade-offs between stability and efficiency, and I had assured that we will keep this trade-off in mind while formulating our regulations. I had mentioned that it will be our attempt to strike the right balance, keeping in view the benefits and costs of each and every regulation. The recent regulatory proposals strive to attain that balance between the drive to innovate and grow on the one hand and the duty to protect. Moreover, in a rapidly evolving banking system, underpinned by technological advancements of tectonic magnitude, no regulator can afford to situate the system at a point of time. The role of the regulator is to guide its evolution within guardrails that ensure stability, fairness, and resilience. In India, this philosophy has found steady expression in RBI's approach towards regulation, what might be called responsive conservatism, a model that prizes stability yet remains open to reform, change, and improvement. In this context, while all of you are aware, you are all veterans in this field, but I think it would still be germane to briefly recap the developments of the past decades in the financial system, in which we have made huge strides, as you are all aware. SBI has become a $100 billion bank. That is also part of this journey. So post the GFC, in the wake of aggressive fiscal and monetary stimulus, the ensuing regulatory forbearance sowed the seeds of the twin balance sheet problem: over-leveraged corporates and stressed balance sheets of the banks. Coupled with the manifestation of external sector vulnerabilities, India got clubbed amongst the so-called Fragile Five. Guided by the principle never to waste a good crisis, the period from 2014 led to a foundational surgery to restore the long-term health of the financial system. This was driven by a series of regulatory measures aimed at recognition, resolution, and recapitalization of the banking system. The AQR, initiated in 2015, compelled banks to recognize the true state of their loan books, bring hidden NPAs onto their balance sheets, and significant improvements were also brought about in the supervisory framework. Simultaneously, the Prompt Corrective Action Framework, the PCA framework, helped restore the health of weak banks. It was followed by consolidation of 27 public sector banks into 12 by 2020. These measures, complemented by massive recapitalization program, strengthened the balance sheets, the capital buffers of the banks, and restored their capacity to resume healthy lending. SBI chairperson was just now mentioning as we entered that in 2018, they were in a loss. And today they are a $100 billion company. The introduction of IBC in 2016 and the pursuant resolution paradigm introduced through out-of-court workout mechanisms have fundamentally transformed India's credit culture. Parallelly, major reforms were taken to strengthen monetary as well as macroeconomic stability. This includes the adoption of the flexible inflation targeting regime, the deepening of the forex markets, and the gradual liberalization on the capital account. The recent past has also seen a number of transformative measures. Financial intermediation has now become a sophisticated and layered system. There are nimble fintechs and NBFCs that assume a greater role in origination. Development of capital markets and credit risk transfer channels such as securitization now provide a conduit for risk transfers. The project finance directions issued recently address risks arising from regulatory approvals and availability of land, etc. The proposed forward-looking ECL provisioning will force earlier recognition of the deterioration in asset quality and provide for appropriate loss buffers. Moreover, all of you are aware, Indian banks today are far more mature than they were a decade ago. Credit and deposits have expanded almost 3 times. Capital buffers too have strengthened. The CRAR has improved by about 4% from 2015 to 2025. Similarly, the CET1 has increased from 10.43% to 14.73%, an increase of 3.4%. Asset quality has improved, GNPA and NPAs have decreased, profitability has improved, return on assets, return on equity, all have jumped. 17-18, it was negative, as was that of SBI. To give you some numbers, return on total assets was negative 0.24 for the scheduled commercial banks in 17-18. And that's not very long ago. And today, it's 13 points. Last year, it was 13.7%, and it has been consistently positive and in double digits for a very long period. So regulation cannot ignore these developments, this performance, these changed realities. This evolution implies that the prudential rule books too should evolve in a calibrated manner as banks are now stronger, supervision more alert, even as alternative risk-bearing pillars have deepened and market-based risk transfer has become more effective. The recent regulatory measures need to be seen in the backdrop of these developments which have shaped the banking industry and the financial system over the last decade. Let me elaborate on a few measures. First of all, I'll speak on the draft guidelines on the capital market exposure. The proposals to enhance the limits for lending to individuals against securities and rationalize the norms for lending to capital market intermediaries are part of the normal process of review, seeking to reset the limits which were set way back 26 years ago in 1999. Importantly, the revision in limits has been accompanied by a more structured LTV framework, which is sensitive to the risks of the underlying securities. The proposed removal of limits on loan against debt instruments while retaining the regulatory limits for equity instruments recognizes the fundamental difference between these two, equity and debt, from a risk perspective. The key risk a debt instrument carries is credit risk, and just like loans, credit risk is expected to be managed as part of the broader credit risk management framework. An additional comforting factor that has been brought in these regulations is that only listed and investment-grade debt securities are proposed to be taken against collateral for these loans. This rationalization is expected to foster a virtuous, positive feedback loop for the development of the bond market. As regards acquisition finance, which is also part of the CME, this is acknowledged worldwide as an integral element of an evolved financial system that helps in better allocation of financial resources. And recognizing this need, even within our own country, non-bank players such as the NBFCs and the bond markets are already allowed to provide such funding. Removal of the restriction on the banks will benefit the real economy, and these come, as you are aware, as the draft puts out, with guardrails like limiting bank funding to 70% of the deal value, limits on debt to equity ratio, aggregate exposure limits relative to tier 1 capital of the bank, eligibility criteria, etc., which will ensure safety while allowing banks and their stakeholders to reap benefits of additional business. Let me now turn to the withdrawal of the specific borrower framework, which was introduced in 2016. This framework was instituted in a very, very different financial environment, as I just mentioned, when the banks were almost reeling under losses. This was a unique measure, which perhaps to our knowledge, no other country has ever implemented at the bank level, at the system level. At that time, the banking system was grappling with elevated levels of stress, which no longer is the case. The tier 1 capital of the banking system as a whole was only about 8 lakh crore rupees. Today it is 26 lakh crore rupees, 3.2 times, more than 3 times what it was. On the other hand, the overall share of exposure of the banks to the corporates has considerably reduced. The regulatory landscape, as mentioned earlier, has evolved significantly. The large exposure framework, which is aligned with international best practices, is now well established. The supervisory toolkit is vastly improved, and therefore it is proposed to substitute the blanket risk weights and provisions in the extant framework with better monitoring and risk management by the banks. Coming to risk weights for infrastructure exposure of NBFCs, I would like to highlight that the proposal seeks to prescribe risk weights on the basis of the risk profile of the exposures. However, certain conditions have to be satisfied to qualify for the lower risk weight. One, there is a set of qualitative criteria that has to be fulfilled ab initio. The details are there in the guidelines. And two, a principal repayment criteria that would demonstrate a reasonable performance track record before the risk weights can be lowered. As regards the ECB external commercial borrowing framework, these measures come against the backdrop of a strong external sector. India's current account recorded a surplus of 13.5 billion US dollars in the last quarter of the last financial year. This is 1.3% of our GDP. Even the first quarter of this year, we had a modest deficit of only about 2.4 billion US dollars or 0.2% of our GDP. The foreign exchange reserves, all of you are aware, are very healthy. Even on the capital account, the flows are very robust. Net inflows to India under the foreign investment, ECB and NRI deposits, in fact, were higher in the first quarter by almost about $4 billion. They stood at $30.4 billion as against $26.8 billion in the period April to July. Our projections show that the capital flows will remain quite strong even during the rest of the year. The calibration of the ECB framework, therefore, is a natural step in India's financial evolution, grounded in strong fundamentals, guided by prudence, and inspired by confidence in the economy's capacity to engage with global finance on its own terms. The removal of all-in cost ceilings will encourage competitive rates and promote prudent hedging behavior. Expansion of the universe of eligible lenders will improve pricing efficiency. Linking the borrowing limits to the borrower's net worth under the automatic route links ECB to the strength of the borrower while enhancing ease of doing business. This limit and the overall soft ceiling of total outstanding being 6.5% of the GDP will mitigate the risks, if any, of excessive external leverage. Moreover, I wish to clarify that ECB will be permitted only for FDI-compliant real estate projects and remain prohibited for speculative dealing or loans for land or property trading. To summarize, all these measures are balanced and appropriate, built on the bedrock of a banking system that has been systematically fortified over the last decade, with financial stability remaining the unwavering cornerstone of our policy architecture. All these changes are incremental in nature, and I quote what Shakespeare said, "We are moving wisely and slow. They stumble that run fast." At the same time, while we move with caution, we need to display courage. And again, I am reminded of Shakespeare. It's dangerous to take a cold, to sleep, to drink. I repeat, it's dangerous to take a cold, to sleep, to drink, to do normal activities is also dangerous. But out of this nettle danger, nettle is a plant which has some thorns, etc. But out of this nettle plant, which has danger, we pluck this flower safety. So these measures do reflect some fresh thinking, but they are incremental and they do not introduce any sea change. Moreover, no regulatory measure, as I mentioned earlier, can be understood in isolation. Each measure has to be seen in the continuum of regulatory evolution and not in isolation. These proposals must be read against the broader regulatory scaffolding which mitigates all these risks. Together, the regulations create a multi-layered defense to keep systemic risk in check. Analyzing merely one regulation without understanding the complete regulatory landscape risks missing the forest for the trees. Let me highlight that the higher responsibilities placed on the banks are based on their past performance. This is on account of improved governance, prudent decision-making by the banks over the last decade. As highlighted earlier, capital buffers are stronger, asset quality better, profitability much improved. Regulation has evolved, keeping in mind, regulation therefore has to evolve, keeping in mind the realities of time and the performance of the banks. Moreover, no regulator can or should, as far as possible, substitute for boardroom judgment. Especially in a diverse country like ours, each case, each loan, each deposit, each transaction is different, different risks, different opportunities. We need to allow the regulated entities to take decisions based on the merits of each case rather than prescribing a one-size-fits-all rule. This will enable regulated entities to experiment and innovate, to learn and improve. At the same time, wherever we have allowed hitherto prohibited activities or reduced restrictions, or we have proposed to reduce them, we have provided, as mentioned, sufficient guardrails to ensure safety and prudence. I may also mention that the role of a regulator does not end just by providing the regulations. His role is like that of a gardener whose job does not stop with providing the enabling framework. The gardener keeps on monitoring the growth of the plant and prunes unwanted growth to shape a collective, orderly, beautiful garden. RBI has ample tools, risk weights, provisioning norms, countercyclical buffers to contain emerging risks. History shows our readiness to act, as was seen most recently in November 2023 when we raised the risk weights for certain types of consumer credit. Needless to say, therefore, supervisory action have enabled effective backstops to moderate or prune unsustainable growth and shape a robust, resilient, and beautiful banking system. Finally, let me emphasize that most of these regulations, measures that we have put in place, they are draft, even though they have been issued after great deliberation, thought, and a pre-consultative process. And while they do reflect the broad direction of the regulations, they are not final. We will take inputs from all stakeholders, and we'll finalize them basis those inputs. Before I conclude, let me also touch upon some of the changes introduced with respect to consumer grievances. The Reserve Bank has maintained a persistent focus on enhancing customer service standards and strengthening grievance redressal systems. Recently, in the last few months, 2 campaigns, one has been already organized, and the other one, the first one relating to financial inclusion has been already organized, and the other one now related to unclaimed deposits is in progress. Good work has been done by the banks, and I'm sure they will continue the good work in this regard. And so in this direction, we have now put out 2 regulations, one for the internal ombudsman and the other for the RBI ombudsman's scheme, which are being proposed to be refined to further improve and enhance their efficacy. It is imperative that the regulated entities too address consumer grievances through mechanisms that are fair, transparent, timely, and without undue cost. The regulated entities may kindly assess the quality of customer service through periodic and regulate thematic studies. Effective root cause analysis of the complaints may also be conducted to identify systemic issues so that such complaints and grievances do not arise in future. I would request all the MDs, CEOs, senior management present here and listening for their full support and their attention in ensuring that the proposed changes, once finalized, are implemented not only in letter but also in spirit. To conclude, I would like to emphasize that our approach is calibrated, granting banks greater commercial leeway for growth, innovation, and ease of doing business, while ensuring that the risks to the banks are minimum and financial stability is ensured. We have set ourselves an ambitious goal of becoming a developed country by 2047. The financial sector has a big role to play in it. RBI remains committed to this goal. We will ensure that our financial system evolves responsibility to support innovation, growth, and the long-term resilience of our economy. I'm sure that the deliberations in this conclave will help in taking this developmental agenda forward. I commend SBI for this initiative, and I wish the conclave a huge success. Thank you. Jai Hind.
Sir, could I please request you to stay on the stage? Thank you so much, sir. It truly looks a very important and enthusing day. Now I request Chairman Sir to please present the RBI Governor with the green certificate. Ladies and gentlemen, a huge round of applause for the RBI Governor Sanjay Malhotra. Now, our first session this morning brings together policy, regulatory, and monetary perspectives at the highest level, and we heard all about it. Let me now move on from this and request everybody to please take seats again as we are about to begin with the first panel of the day. Everybody, please be seated in your seats. We are about to begin with the next panel. Everyone in the back who's standing in front of the gates, could I please request you all to be seated? Okay. Ladies and gentlemen, let's now move on to our first panel of the day, the topic for which is scaling with purpose. Now, family businesses are the backbone of Indian enterprise, and many are now entering the next era of professionalization, global expansion, while ensuring continuity of legacy. The conversation will explore how scale can align with purpose, culture, and long-term stewardship, even as core competencies get redefined. Please join me in welcoming on stage our moderator, Professor Tulsi Jayakumar of SPJIMR. A huge round of applause, ladies and gentlemen. And to our panelists, Shri Ankit Kedia, founder and lead investor, Capital A, Manjushri Technopack Limited, Ladies and gentlemen, the applause should not stop. Shri Sumit Kabra, Director RR Global, Shri Pranav Sharma, President Baidyanath, Shri Siddharth Agarwal, MD Systematic Group of Companies, Shri Rama Mohan Rao, MD IBG MNT at State Bank of India. Ladies and gentlemen, a huge round of applause for panel number 1.
Hi, good morning. Can you hear me? Okay. So it's a very interesting panel in the context of today's conclave. Why are we looking at a bunch of family businesses? Because family businesses constitute more than 80% of the businesses in India. Small and medium businesses in particular contribute to more than 30% of the GDP. They account for huge employment. They also account for more than 40% of the industrial production and more than 45% of the exports. So what you have here on the stage is just a small set of the kind of businesses that drive India and that are going to probably take India to a $1 trillion economy and, as the RBI governor spoke about, a developed economy by 2047. But what are the kind of contradictions that we are talking about here? We are looking at these businesses being driven by the 3 Ps, of course, which have to be very, very critical going forward, driving the businesses through profits, planet, and profit. But more importantly, driven by a 4th logic, which I call perpetuity, which is the 4th P, which seems to be a supraordinate logic, trying to reconcile some of the conflicts among these 3 logics, which are the people, planet, and the profit. We're also looking at a tumultuous world. We're looking at a changing world order, greater and greater demands being made on costs and competitiveness, and possibly the moment of truth where you will have to kind of contend with a moment of truth as family businesses, because you not only have to look at scaling, but you also need to be scaling with purpose. And that's what this particular panel is all about. Let me also tell you that there is a research, though it's not something which I believe in, but there is a research which talks about a 30-13-3 rule, which is that family businesses typically do not survive into the 2nd generation. More than 30% of them do not survive. More than 13% do not survive the 3rd generation, and more than 3% don't survive beyond the 4th generation, right? And I was looking at some statistics. Most of Indian businesses are in the 2nd generation. So does that spell disaster for India, or is it that we need to look at the way in which we could probably turn around the curse? So we have with us panelists. We have Mr. Ankit Kedia, who is 2nd generation business, right? So he was leading Manjushri Technopack, a family business, which they sold out to a PE fund. And Ankit himself is someone who has set up his own venture capital fund, which is Capital A. Then I have Sumit Kabra here, who is the director of RR Kabul. RR Kabul has gone in for an IPO recently. It's in the wires and cables business. I have to my right Pranav Sharma, who is the director of Baidyanath, one of the very, very old and well-known Ayurveda companies in the world. But Pranav himself is an entrepreneur, and he has started a bunch of companies, Shunya being one of them. He also has pioneered the group's journey into renewable energy, bioethanol, LNG, and nutraceuticals. To my left, I have Mr. Ram Mohan Rao Amara, the MD of international business, international banking group, the global markets and technology domains at SBI. Someone who has been a banker for more than 35 years now. Thank you, Mr.
Perhaps an odd man in the group.
No. I think they bank with you. And to the extreme left, I have Siddharth Agarwal, who's the Managing Director of Systematic, which is a group which has currently gone in for an IPO. And Siddharth himself represents a family business, a second generation, but he started Systematic with his family support on his own. So a round of applause for this panel. I think it's an extremely good panel that we have here. So let me just start with the first question, and I could have any one of you answering this. When we are looking at scaling, right, what are some of the non-negotiables on the path to growth? How are you looking at balancing ambition with responsibility? We could start with you, Ankit.
Good morning. Maybe check. Let me take a stab at that. One of the things with getting involved with the packaging industry is that you have to be creative at all times when you are dealing with various FMCG brands like Unilever, Nestle, Coca-Cola, Pepsi. You have to be creative with your packaging. And that then begets the need for innovation. And one of the things that we kept trying in our growth trajectory was to keep doing these small dipsticks with innovation, small ideas with, where we kept saying that, can we try this, can we try that, can we develop this, can we get a machinery to manufacture this part or that part. And what happened is, in that process of doing these continuous experiments, we always landed up in, out of 10, at least 4 times, ending up with something very different from what our competitors are offering. And in that sense, that growth sort of started from a DNA of innovation. That as a company innovates continuously during its journey of, the generation 1 building the foundation of the business, and then generation 2 blending with the DNA of the foundations of 1, as well as some new ideas of generation 2, sort of blending that and amalgamating that into some innovative ideas. A few non-negotiables for us was that at the core of it, we never lost sight of customer centricity. And I'm told that the finance minister spoke about it yesterday, that customer centricity is so important. The experience of the customer for a packaging can be great, but if I'm not able to engage with them continuously, and if I'm not able to sort of meet them on fundamentals like, processing their order on time, timely delivery, and making sure that they are felt, important, I think that sort of loses, that sort of completely dilutes the overall functioning of the business. And for us, that was a very big non-negotiable.
So non-negotiable for you was customer centricity. Great. I think that's something which almost every business would speak about. But I'll just give you my perspective on why customer centricity becomes even more important for family businesses. I've heard family businesses saying that the way in which the family stays together is through the value of everyone saying that customer is God, and whatever differences we might have, but when it comes to customer centricity, that's what binds us together. So interesting that it is the profit logic which kind of reinforces your perpetuity logic, right? Yeah. So I would also like to ask maybe Pranav about the moats that you created. You're looking at Ayurveda, the kind of moats that are required for Ayurveda to kind of stand up against modern day, medicine or modern day products. What are some of those moats of excellence that you created, and the networks that may have helped you to create those moats?
Good morning, everybody.
First of all, I am a third generation, so I am actually in the other side that you were mentioning a short while back.
Okay.
But I am glad that for 108 years, we must have done a few things right to keep things afloat and growing, hopefully. So to answer your question, you know, we have had to rediscover the way Ayurveda has been looked at from a consumer perspective again, because we are looking at customers in the form of doctors as well as retail consumers. Outside India, more so, because outside India, there is a healthy skepticism to understand what Ayurveda is, to understand what natural products for well-being management is. Because we are not talking about a parochial problem. We are talking about an overall problem where we are trying to address the consumer's issues, and we are not talking about only the vested interests of manufacturing companies like ours or anybody else. We have to keep the patient and his requirements at the center, at the core, and therefore the nutraceutical division that we started was more to actually align with doing combination therapies between novel ingredients that are well researched, well documented, safe, and we are able to blend that with the age-old tradition of our herbal understanding of Ayurveda and trying to standardize evidence-based so that we can actually give more and more confidence to the consumer who is taking these products, because we all today, even when a modern doctor prescribes the product, we all use our Googles or Chat GPTs to actually check the pros and cons. So it's not very difficult for anybody to lose confidence in the best of doctors, sometimes advising something that maybe from the doctor's perspective the right thing to do, but from the consumer's perspective may not be the right thing to do. So therefore, in that sense, we have become, all of us have become very, very discerning. And we cannot today shortchange the consumer at any point in time. So I think for us, the learning has been that we have to reinvent novel delivery forms. We have to improve our communication. We have to make it crisp, clear, and we have to make it customer-centric to the point where if we are targeting a doctor, then we are trying to address the gap in doctor's repertoire. So if a doctor has a particular therapy where an allopathic product, for example, may not be giving him the desired results, then can we come in and give him that solution in that segment? So I could give you an example, but it will become too esoteric. So I'll leave it at that. Thank you.
Okay, I'll come back to you, because from a 108-year-old company to starting shunya, you went back to zero, so we'll want to hear that story also. But coming to Mr. Amara, is it capital which is a constraint to the family businesses today, or do you see the challenge as something beyond capital?
I think in the beginning phase anyway, the promoters are there to bring in their capital, and by virtue of their connect with the local community and the trust they have from the community, they will be very easily able to mobilize the capital needed. But the issue arises once they want to diversify into other lines of activity, or diversify into different customer segments, or diversify into various geographies. More than capital, it calls for certain fundamental changes. The challenge here is like the model of family business is endowed with a lot of positives. We know like the entrepreneurial spirit, the ability to identify a business opportunity much before others, and the ability to quickly execute that by mobilizing the resources is tremendous. And of course, they have a very good reputation among the community. But for scaling up, definitely, I think a different ballgame is required. They need to professionalize the entire setup. They need to invest in technology. More so particularly not only in their internal operations, they should also offer a kind of D2C kind of play they need to have in e-commerce. And of course, it goes without saying, like professionals have to be there in various areas, like whether it is a financial reporting or disclosures have to be more authentic and reliable. And of course, I mean, finally, what you said, the purpose. I think they need to now figure out, like, while they transition to a much more diversified, a professionally run entity, how do they keep that original idea of delivering value to the community and still having a professional setup, not losing it in a different, in the new avatar? I think that will be the challenge. But if these elements are in place, I'm sure there are plenty of players, not only the traditional banks, there are other risk takers like NBFCs, AIFs, etc., who are willing to provide capital to them.
Correct. Yeah, absolutely. I'll come back to some of the other challenges that you as a banker might face. But Siddharth, from a family business which was into manufacturing of steel tapes to starting your own wires and cables business at the age of 23. What prompted you to diversify? And that's what Mr. Amara was also speaking about, the need to diversify. And how did you keep purpose as your North Star as you went about diversifying? Today you have successfully executed an IPO, so that's quite a journey in itself.
Yes. Hello. Yes. Good morning, everyone. So at the age of 23, we don't know what to do. When I was in college, and the most interesting thing, they were talking about management, they're talking about leadership and everything. So I used to ask to my friend, सबसे important है कि माल बिकेगा तो आगे सब कुछ होगा. So first, the most important thing is the sales. So we don't have the revenue, and we are talking about management. But now, after coming about 20 years, and now I can recollect all the chapters, that leadership and family business and all those things, management are the most important thing, because those are the crux, and you can, with that, you can control the business. Just adding on the scalability, what is there, that one thing which I work on this, that companies like where we operate is very highly competitive industries. So where all the models in terms of technology, people and products are replaceable, or you can be, other person can copy from one person to another person. So what had worked for me is human connection. So for example, I have 3 bankers since the banking summit. So 3 bankers are giving to me the rates, and everyone is giving the same rate. Someone is giving almost the equal rate, but I will work with a person with whom I feel comfortable with. So I will go with a person with him I can connect and I can sleep peacefully. The same thing I want to apply to my customer. So what we can do is, if you are dealing with systematic, you can sleep well, you know that everything will be taken care, and your life would be easy. So I work on those principles and move the journey from that place to this place.
Great, thanks, Siddharth. So Sumit, coming to you, it's again a wires and cables business, and it's a business which is extremely price sensitive. Where others are competing on price, you have looked at safety, you've looked at things like trust as your differentiator. So one, how do you look at these as differentiating elements? And two, it's okay for you to speak about safety and trust, but how do you operationalize some of these things?
Good morning, everyone. Thanks, SBI and Madam, to felicitate this panel. Well, our name, RR Kabil, itself distinguishes and differentiates on the safety level. When we say we are the only company in India who represent as RR Kabil, so outside the Asia, if you go, the European regions, they mention as wires as a Kabil. And that's what we decided from the day one, that we will make a best European wire and cable quality and make in India and make sure that we export to the Europe and the rest of the world. Well, when it comes to safety, of course, for us in a price cutting market, it's very important. We found out a lot of import substitute and also as a solution provider to our customers. When I say, I still remember, we designed a fire alarm cable in 2010-11 itself, where even if the fire is there, the circuit integrity will be on for at least 3 hours. And that equipment for testing was not available in any of the labs in India. That's what we designed at point of time, where after there is a fire on the wire, and there's a mechanical stabbing where we run on the fire. We designed that whole system, mechanical heating on the wire, and after 15 to 20 minutes, there's a water sprinkling where ambulance and other fire brigades are coming, and how the wire performs after the fire as well. And this is kind of innovation and depth level we have done. And so, of course, it's very paramount to be competitive in the world, but at the same time, what we learn from it, if you are able to or create some solution provided to your customers, you can sustain in any of the markets and you can create a brand out of it.
That's a great perspective, Sumit. So, to Ankit, what we find today is, and this is something which I've seen, a large number of the next generation seems to be moving away from wanting to do the operations, to run the operations of the business. I was recently in conversation with a young family business scion from south of India, and she's a female. She currently runs the operations of the business, and she was telling me how in the south, in Hyderabad in particular, a lot of the family businesses have set up family offices with the next generation running the family offices. So what does the move away from leading the operations to becoming investors mean for family business capital in India?
You know, I sometimes grapple with this question a lot, that, you know, you were a part of a family business and then you exited that business and now you have set up your own venture capital fund. And while I know you are not implying it, but I've also in other forums sort of got a feeling that, you know, it's easy money. Your father, you got this money in inheritance, or you got this capital in inheritance, and it's easy to deploy this money in a bunch of startups and wait for them to grow and sort of give you the returns. Thankfully, and while that exists in many other scenarios, I joined the business in 2006. Just to give you a little bit of a backstory, my father came from Assam. We used to manufacture umbrellas there because it used to rain a lot in Assam. And we then shifted in '95 in the midst of extreme terrorism, insurgency, and all kind of things in that area. And when we moved to Assam, I think we didn't have it easy. When I joined in 2006, right after college, I was actually put on the shop floor, and you know, I was not given a fancy cabin. I was given a small cubicle to help the production planning department. Now, the reason why I'm giving you this story is there is 4 years of that time that I spent on the shop floor, and though I'm a business graduate, taught me so much about engineering and the science of packaging and blow molding that no other engineering institute could have taught me. Only in 2010, when I was about to get married and my in-laws were coming to the factory, did my father promote me to a cabin, because he said, the in-laws are coming to see the boy. It's not nice to see you working in a cubicle. Let me put you in a cabin. So some of these things, you know, also happen by chance. It also happens to manage optics. I was very fortunate to put 15 years of operational experience before starting my fund, and the ability or the deep operational expertise that I was able to inherit from the family business sort of helped me to deploy this money. And now as we run the fund and when we sort of mentor a lot of entrepreneurs and a lot of companies that we are investing in, it just gives us so much joy to sort of use those same experiences to tell these folks what not to do. What to do they usually figure out, but at least what not to do and what the pitfalls are, that becomes very important. That's the thing that we've sort of seen in this entire generational pass on. We have the new generation coming in. My uncle's son is coming into the business. He's all of 21, 22 years. Surprisingly, he is absolutely interested in one of our other packaging businesses, and he, you know, likes the fact that he is supplying to brands like Starbucks, Chayos, Chai Point. Is also a part of the a premier MBA institute. So I think, you know, it's also going the reverse way, where a lot of newer generation folks are leaning on to the family legacy to create newer legacies for themselves.
So according to you, the capital is not going to be dissipated, it's going to grow. That's what you would say.
Absolutely, absolutely. Capital is commodity now. We are getting access to capital thanks to the banking system, thanks to the private equity markets. But I think the legacy that we inherit is going to be invaluable.
So I would like to ask Mr. Amara at this point of time that when you're dealing with family businesses as a banker, what are some of the points that you would want to insist on in terms of, say, governance within the family businesses? Is that something that you're looking at? Because increasingly, I think that the business dailies are splashed with news about some more conflicts and some more issues within family businesses. And these are leading to a capital being dissipated, not just for the family, but for also multiple shareholders.
A very, very, very pertinent question and a very contemporary. I think as a lender, generally, whenever we look at any, taking a exposure to any company or any business, fundamentally we look at three parts. One is the financial risk, how it is faring. More than that, of course, the business, the sector in which it is operating, and more importantly, what we call a management risk. Management risk. What we mean is, it's a very nomenclature. Management risk essentially means, is there a proper succession plan for a promoter who has been successful so far, with whom we have a very satisfactory relationship. They have been repaying our liabilities very well, and it is also growing, and their working capital or the term loan or project finance requirements are growing. But back of our mind, always that thought is there, like what is the succession plan? And whether, as Mr. Ankit has said, whether that second generation is taking an interest actually in the activities, are they being groomed in the traditional business or not? That aspect definitely we look at. Second aspect, of course, is whether it is being run by professionals. I mean, while the oversight of the promoter can be there, even when they age, etc., that has to be there, but day-to-day affairs and the execution, operations, etc., are they being managed by professionals, whether there is a qualified CA to take care of the financial reporting, whether there is an operations head to run the operations, and whether they have a proper marketing, and more importantly, whether they have a business plan, which talks about like what is their ambition, etc. So I think these qualitative aspects actually gain a lot of importance more than the financial ratios, etc.
That's a very, very important point. And I believe that all family businesses need to keep that in mind, that while you're going forward, the legacy that has been built is not the legacy that will continue if we do not take into account putting in place some guardrails. So, Pranav, when you have expanded your business and when you have moved into newer businesses, how is it that you're ensuring that the points that Mr. Amara was speaking about are being put in place for your legacy business, even while, you and Sidhesh and the others in the family are diversifying into newer and new ventures?
I think to his point, when we actually looked at doing infrastructure and getting into areas which were sort of resonating with the family, with myself, that we were doing clean, green medicines, we said, why can't we also get into sustainable businesses, which is basically your next, the Conclave's next forum discussion is on sustainable climate change businesses. We said that what is it that India is looking for? India is looking for renewable energy. India is looking for bioethanol to blend in petrol so that we can reduce our import bill and genuinely make ourselves more Atmanirbhar and of course move our economy from fossil fuel based economy to more greener economy and making ethanol probably as a base fuel. Moving the share of gas from 6% odd to 15% is what the government of India was also planning on doing, and they actually announced it a few years ago. So we looked at LNG again as the cleanest form of hydrocarbon in that sense, which was environmentally friendly and also economically friendly. Because in developing markets, E stands not necessarily only for environment, it also stands for economics as much as environment. And that's the practical aspect. But to actually answer this question differently from a family business perspective, when you look at infrastructure and you look at infrastructure financing, you look at equity IRRs, you have to approach lenders, you have to look at raising finance at competitive rates on terms and conditions that actually make sense for the business and the investment and the investor, so that it basically gives every stakeholder something in the chain to make. So when we looked at renewable energy initially, of course, there was a lot of hesitation because Baidyanath and consumer businesses largely were businesses that were negative working capital businesses. We did not need to borrow too much term loans, too much working capital in that sense. But when you actually look at infrastructure, you're looking at completely the opposite end of the curve. So I did have a challenge in explaining this to my father, but I had to build my own equity, not only internally, but also externally with lenders. So I'm happy that in the last 15, 20 years today, lenders are more and more comfortable lending loans to our infrastructure projects with me being in the center and not the family, because giving collaterals, giving personal guarantees, all of these are very touchy issues in third generation family businesses. And I'm sure lenders would experience that a lot too. So negotiating, doing the commercial contracting right, and all of that becomes very essential to ensuring that the family as well as the business can actually remain in harmony.
Absolutely. So that we'll come back to that, but Siddharth, how difficult or easy was it for you to get your family to agree for an IPO? Because I'm just speaking about this tendency of family businesses not to want to lose control. And that goes to even borrowing. So most family businesses would say with pride, we are a zero debt company. And you're looking at you going in for an IPO. So how difficult or easy was it to get your family to agree to an IPO?
So I'm very fortunate that we had our IPO ringing ceremony in the same hall 1 month back. Okay, and I'm talking about the same event here. So for me, it was not very difficult, as my father was, it was my father's dream that he wanted it to happen. And so there were two choices. I could have waited more and make it much more bigger. But then I thought that sometimes your father's dreams are more important, and that's why we went. And in terms of integrity-wise, I will say that we have not diluted any offer for sale. We have kept all the money in the company. So our thought process is that we have to grow with this, and we have to multiply, and whoever has put the faith and trust in the company, we have to give multiply the rewards to him.
So, Sumit, what about you with the IPO? What was it like?
So for us, IPO was a clear plan because TPG was an investor who invested with us in 2018. So roadmap was clear from the day one. And we gave ourselves good enough time to prepare ourselves, almost 3 to 5 years, where a lot of structural changes were there on the top management level. And also the best practices and the governance were implemented during this time. So for us, it was a very easy roadmap to execute for an IPO.
So the family in particular did not see it as something, because I've heard you saying this, keeping the family together when you're making some of these decisions becomes extremely critical. So what was that large purpose which held you together?
Well, of course, once you decided that to get PE on the board was one of the tough decisions. So, but we have a good culture, I always say a statement in family business, हमारे बीच में मतभेद है, but मनभेद नहीं है. And this is what we say again and again in our mind to get the consensus at one level. And we follow the structure. If majorities are aligned towards one decision, we always 3 other sides support to that decision.
Sure. So I would want to ask the 3 largely family business people right now here, and then Ankit also possibly. How do you adopt a patient mindset in an impatient world? Right, because family businesses are known for their patient capital. They are looking at not just quarters, as I call it. They don't follow a QSQT, a quarter se quarter tak model, but they are looking at it in terms of generations. And here we are talking about an impatient world, a tumultuous world, a world where the order itself is being restructured. How do you ensure that you keep a patient mindset as members of the 3rd generation or the next generation, even while, and how do you also look at the Gen Z, which is your next generation coming into your business? How do you ensure that there is a certain amount of patience, jisko kehte hain thehrav, right? How do you manage that?
To partially answer that question, when we look at what foundational values our forefathers built in the brand, we really take inspiration from that, because in today's times, everybody is looking at burning cash at the rate of knots. Traditionally, we always looked at building sustainable competitive advantages for growing the business and keeping it afloat and relevant, and not only looking at valuations. So I think over the last few years, and without disrespecting anybody who's doing it today, and I'm sure all the Gen Z businesses, the new businesses that have come about, you look at the Zomatos and the Blinkits and all of these guys, they're doing phenomenally well. But there are so many other businesses which are also growing, which are brick and mortar. And we feel that the values that our forefathers inculcated, those values still remain very, very relevant. For example, if there is efficacy lent to a particular product using a particular method that was prescribed in the traditional texts, today if we try to shortchange that, there are differences in the efficacy levels that you actually see, even though you will end up making more money in the short term, to the point of RBI Governor's speech initially when he said that at the detriment of long-term
value,
you should not look at only short term.
Correct, absolutely. So, Sumit, your thoughts on patience in an impatient world?
So I completely agree with Pranav. Like the value systems which have been imbibed with our elder generation in ours. And I always say that, this values imbibe is not in the boardroom, it's always in the dining room, where we discuss with our father, grandfather, and elder generation that what should be done on the personal side. Well, of course, patience are important in this FOMO world, especially where many a times you feel that this startup started before 10 years and they are $1 billion, and you see yourself struggling for 27 years and trying to build up a $1 billion. So this kind of, comparison, the pressure from the outside world, this is certainly creating certain pressure, but we know where Pranav said that long-term strategy, the end of the day, profit matters a lot. And we know that we are building up a sustainable and profitable model, and we have to build up on that. So we always believe that our foundations are strong on profitable and sustainable model, and we have an opportunity to focus more further.
Sure, sure. Yes.
So for me, patience does not mean being slow. For
Right.
me, patience means to have a clear-cut map, being consistent, being persistent, and sometimes you know that you have like something short term which you can do, and okay, you get the sales, but which is not good, which is not, doesn't fit in your value system. You invest in the people, you invest in the process, and sooner or later it is going to give you returns. They say that you have to have belief in yourself. If you have belief in yourself, then things will grow.
Sure. And sir, Mr. Amara, have you seen a difference in the way in which when you're banking with a startup versus when you're looking at a family business? What is the difference that you would note?
Yeah, I think incidentally, among the banks, we were the first ones to start what is called startup branches. That is, we realized, even though we had a very elaborate setup by way of SME intensive branches, and for larger corporate needs, we have CCG branches, CAG means corporate accounts group branches, we felt like catering to startup is a different ballgame altogether. Particularly the ones who are starting in the beginning may not be fit for a bank financing straight away. I mean, their needs are very, very simple to begin with. Some transaction banking and some personal banking needs of the promoters have to be taken care of. So we have set up these branches in the startup hubs. It also, besides the traditional bankers, they also have people from the wealth, they also have people from the cards, payments, etc., to help them start their operations. And they also actually connect, once the proof of concept is done and once they are confident of actually showcasing, we also connect them to the investors. In fact, we also have our own venture entity, but of course, if it is not fitting in their scheme of things, then we connect them to the others. But once they reach a stage, I mean, I'm talking about a kind of maturity where it's a commercial scale kind of operation. It is only like they need growth capital. Definitely we pitch in there. We have created special schemes, and I should credit even the government of India for encouraging financing to startups in a big way. They came out with a scheme up to financing startup up to 20 crores without any collateral, without any personal guarantee of the promoters. Up to 20 crores we can extend. So we are leveraging that actually for the startups. So we realize startups is a different ballgame altogether. It needs to be approached with a different mindset, not a traditional mindset of looking at positive cash flows, sustained profit. These things don't work there. So you have to take some kind of bet, but it is calibrated and a calculated bet we need to take. And we also know some of these startups have the potential to become unicorns, and actually their requirements will increase further going forward. So we actually would like to always handhold them wherever we come across.
Sure. And maybe the new age startups are going to be the old age family businesses, as I think this panel represents. Ankit, just taking this conversation forward, how do you look at these new age businesses which come to you for venture capital and they're chasing value? So what are you looking at? How do you separate scaling with purpose from those who are merely chasing valuations?
There has been a lot of discussion around startups, valuation, and it's also reflecting in some of the market caps of some of these startups who are listing right now. And we are seeing companies like, Lenskart drawing criticism from the shareholders for its, perceived cost economics and valuation. Maybe let me break this down into two parts. One of the things that these startups, the idea for these startups to first of all, take that leap of faith and go on to their entrepreneurial journey was never to start a business which will organically grow or would never be a lifestyle business. The startup is always, you have an idea, it's a new age idea, and it can be grown with agility. If these elements are missing in the foundation of the startup, then it was never a startup to start with. It was always a lifestyle business. Secondly, the first phase of venture capital money that came in, that was sometime between 2010 and 2020, has led to the torching of so much capital. So much capital has eroded into funding startups that are, were never focused on revenue, profitability, defensibility, differentiation, and was always based on some vanity metrics. That has unfortunately sort of set benchmarks for the startup industry as a whole. We've seen some amazing success stories with Flipkart, with Swiggies of the world coming from the foundries of India. But what's happening is you will see a lot of media attention towards the real economy, the manufacturing economy, that everyone is talking about. The entire China plus one story. We perhaps might not become a China plus one story in the immediate future. Can we get there perhaps in the next 10 years? Is where the government, the policymakers, the state governments are all framing their policies in that direction. And startups who fundamentally believe in the valuation game perhaps won't survive that long. The VCs are also pressing the reset button on this entire valuation metric. They are focusing on what matters. And for us at Capital A, we back manufacturing businesses because that's the business I understand. And that's tangible, that has credible outcome. The evolution of startup entrepreneurs from pure play tech to hardware plus tech is being witnessed now by the industry. So it's no longer a game of valuation anymore.
Sure. I'll just wrap this up before we'll take about a question or two. What does purpose mean to you? Anybody can go. Purpose to you means what? Pranav?
I think purpose is genuinely to solve a problem, and the problem solution and the problem solving has to happen in a value accretive manner for the company, the customers, everybody, so
All
that
the
everybody comes out winner. So, I'll give you a quick example. When we thought of starting to look at Ayurveda globally, we said, what could we do? So let's say we started with a small country in Europe called Romania. and we said that can we start to own the way doctors prescribe nutraceuticals and natural products in this country? So we actually went about setting up the entire company's systems and processes in such a manner that everybody was set up to succeed. And today, in about 3.5 years, 14,000 doctors in Romania are actually prescribing Ayurveda-based Nutra products. And today, we are the fastest growing nutraceutical company. I'm not boasting about the company here on the platform, but I'm just trying to buttress the point that if you have the entire incentive systems correctly in place, you don't really have to have robust HR policies. If every employee knows that at the end of the year, after achieving what is it that he or she can get, I think they are automatically motivated. You don't need to have convoluted, long, protracted sessions on management or motivation when everybody is motivated with your clarity as the leaders of the organization.
Sure. Sumit?
So for our company, purpose has been always to build up a safety wire. There are thousands of people who die every year because of the short circuit. And we decided from day one, whatever we takes, we'll sell only safety wires in the market. Well, purpose helps, I think, 4 steps. It's always there. Purpose helps you to decide your priority. If purpose is clear, your priority is there. And if your priority is there, it will help you to increase in your productivity. And if your productivity increases, which generally results into profit. So if you follow these 4 steps, which will lead to the profit. So purpose to the profit is for me like this.
That's a very nice thought. Okay. Yeah.
For us at Capital A, our purpose is very simple, is to make our founders successful. We don't have any more jargons to add to it, because whatever we do at the end of it, we just come back that the success of the founders will lead to our success and everyone else's success.
Sure. So that.
So I think purpose would be different for every person. For me, purpose is to being happy. So if I am running an organization, I should feel happy with the people around. And it is my dream that to have an organization, even if I'm not there in the world, to have an organization where people feel connected and the organization keep growing. So that is my purpose of doing the business.
Great.
I can also add from a banker.
I wanted to ask you a question also, because
Slightly
you
deviation.
wanted the last word with SBI.
So, I mean, we already play a very significant role in the development of the country. So our purpose is to continue to play that role in a much more effective manner,
Sure.
But also taking care of interest of all the stakeholders, whether it is a customer, whether it is employees, whether it is a community, or whether it is the shareholder. I mean, all put together, we want to take care of the interests. Yeah.
But I wanted your last word on how would you see the rock star businesses, family businesses from the also-rans? How would you define those businesses?
I said in the beginning, I think particularly when they want to become rock star or when they want to scale up the operations, certain basic elements have to be in place. Talked about technology, talked about professionalizing the entire management kind of setup, investing in internal control, strengthening, while at the same time carrying the virtues of the family business. They connect with the community and living with that purpose. If they're able to combine all these things, I think they will become a differentiator as compared to the rest of the pack.
Thank you all so much. We'll open the floor to some questions. A couple of quick questions if there are. Who have a question?
Hi, ma'am. This is Adi Shankar.
Oh,
Firstly, I want
hi,
to tell,
Adi.
yeah, ma'am, how are you?
Good,
That's
good.
what I'm about to tell, that I am also SPGN student.
Yes.
And nice to see you here. And I know what we learned from SPGN, definitely. And ma'am, now, so I'm so happy to see the family business entrepreneurs on the stage. And firstly, thank you very much for the SBI for giving this opportunity also. Ma'am, basically in this family business, when it is growing, definitely, there is no problem. As one of entrepreneur, he said that the startups are basically a lifestyle changes. Like, when they see the gap between the market, definitely, new idea generates into the startup. And sometimes we have seen number of startups are very successful. In that case, when the traditionally, conventionally industries, since ages 30, 40 years, we were into the industry and we are not able to, catch that trend. So when that third generation or fourth generation, assess, okay, this is the trend and this is the gap, we need to fulfill that. And how do they handle for the change? How do they convince their forefathers and fathers for the change? This is one thing. And second thing, ma'am, in the family business, what luckily my father and my uncle is also here. Luckily, they are very supportive. When I have entered into my business, we were doing 275 crores and now we are into 3,000 crores because they have given that liberty for me, and we have digitalized massively. But, so many companies I don't see, family-owned companies, they were not so upgraded, not so advanced. But what is the message you give them, how to convince their fathers and forefathers for the change? Because when family is growing, number of brothers are growing, definitely one say yes, one say no. In that contest, how do you prove yourself this is correct for the market?
So this question is to whom?
Actually, any of them can
Anyone can answer?
Ankit
including the moderator?
Ankit ji? Yeah, anyone.
Yeah, sure.
I will take a, I'll take a stab at it. When we were just starting off, one of the things that, in fact, Sumit and I, when we were in the same batch, and we sometimes used to discuss this back in college, that, we will, as new entrepreneurs in a family business, you always have this idea, and if you have a new idea, you blow air into this balloon and blow that balloon so big. In your mind, you think this is going to be the best idea ever that will transform your company. And then when you take it to your dad, he probably has a pin behind just to go and prick that balloon and burst that balloon. And there goes your idea. I think most of these times, these ideas exist in our head and not really in reality. Because if we are too premature, the day you join the business and the day you introduce those ideas may not come into life. At least that was my experience. I was fortunate to have a lot of advisors and mentors, in the business. Some of them are sitting amongst us. We actually had to earn it. And the way to earn that was to earn the trust of your family that whatever you are doing right now is aligned with their ways of working for some time. Once you understand the business and then you say, I have this new idea which I want to try, can I take a stab at it? That's an organic journey. That's been my experience.
No, absolutely. I think two things here, Adishankar. One is the trust that you have to earn, right? It can't be that, oh, I'm now 18, I have this idea, as Ankit said, and that the world is going to change because my idea is going to be put into order, right? So that's one. The second is also for the senior generation to be educated on this concept of what I call a stop loss. What is the amount of risk that they are willing to place? What is the bet they are willing to place on you? And what's the amount of money that they would lose on a new idea, which is yours, or any other new idea for that matter? I think both of these would be important for all new ideas to be tested and verified. But before that, you have to earn the trust.
Yeah, and I think just to add to whatever you said, very clear division of roles within the family when you are actually expanding and the family is also expanding. Because it does so happen that whenever you are assessing risk in a family business or a reward in a family business, you're always having the benefit of hindsight. So, when a business is seeded to when it actually matures and starts making money, there are differing perspectives, and the moment it becomes successful or not so successful, the views are always very, very differing. And if you can have a constitution or some sort of a vision statement or a clear statement of purpose within the family of who's entitled to what, because the other problem in family businesses, I would say, apart from all the opportunities that we get, is the sense of entitlement. Because we are born in that family, we should get the capital by default. And to Sir's point that we must have professionals therefore and have the ability to actually concede to the professionals because they are professionals and they're actually going to be able to help you add more value than you can as a family business, to actually realize that and have people who are far more intuitive, far better than you. You know, in Harvard they say in the business programs that, you know, how many decisions do you make based on numbers and how many decisions you make based on gut. You know, they're saying that you should move 90% plus the decisions based on numbers rather than only gut. And of course, there is an element of risk in the business, which is why you can't solve all the problems or all the pieces of the puzzle. Otherwise, it would have been like an FD. And there would be no upside. So I think those things are very, very crucial when you are actually trying to put the building blocks into place.
Okay, I think we have completely run out of time. And I think that's time, right? Yeah, yes.
I have one observation. I don't call it question. The very purpose of bringing you guys here is essentially to understand that what is the trajectory for Indian family-owned businesses. Let me tell you, 90% or even more of the businesses which India witnesses today all have started as family businesses only. I mean, this differentiation of family business is artificial. Every conglomerate what we deal with today essentially started as a family business somewhere. But the success story of these conglomerates also you need to absorb and observe and understand. And what, in fact, my question, Adi, has preempted me asking that. The basic friction comes in the family business. From a financing point of view, we have seen a lot of businesses over the years, is that each generation would like to pursue something different. And how the families facilitate that is the one which made conglomerates to grow and survive. Whether you take Tatas, Birlas, Adanis, Ambanis, all of them have started as a family businesses, but they were able to, our family members were allowed to think beyond certain boundaries. So, as I agree with Tulsi in terms of allocating certain risk capital for each generation. You can't risk the whole family business, obviously. You know, this is what we look at. Are you risking your fundamental basic business by venturing into non-core activities, what we call non-core? But if you are convincing the financiers that this is a capital which we are willing to set aside and allow our family members to think differently, is something what I would definitely recommend to all the family businesses. That is how the conglomerates have grown globally.
Absolutely.
If any of you want to supplement my view, you're welcome.
Sir, I completely agree. I recollect the 2018 conversation where fortunately very few deals happened where we got a secondary money from TPG. So after a long time in growing business, you never have a free capital cash flow to spend on yourself or probably the new ventures as well, right? So this was the first moment where we had a good significant amount to live a luxury lifestyle. Me and my brother were sitting in a room with my father and said, like, okay, you have two options. Either we buy all luxury cars and houses and everything and stay good life and the original business is continuing, or else we have a startup businesses where we will invest and try to create 1,000 crore valuation out of that. It was really me and my brother who took an intuitive call along with my father, who gave us an open culture and open environment to take this bold step. You won't believe, within 5 years, brother and me, we are able to create 2 startups, which is valuing more than 1,000 crores right now at this stage. So it is all up to you. Like, so we ventured into electric scooter segment. We build up a very good technology on light fidelity, where through laser beam communication, we give internet connectivity, and through visual light communication, we are able to transfer the data. And we are working with defense right now. So altogether, new sectors opened up in last 5 years, which we never knew, and we started all together.
So in my experience, what I would see, and which is actually aligned with the theme of today's session, is that it's not enough for you to think you have a purpose. It's also important for you to be very clearly communicating that purpose to multiple stakeholders, not as a marketing rhetoric, but also as an internal marketing for your own family members, where everybody is aligned to that purpose. There is a clear line of communication. There is freedom to voice opinions, and people are allowed to think and to be able to put their points across. I think that purpose and the way the buy-in of every family member into that purpose is actually actively sought is going to make the difference between kind of a family business that SBI would and any other banker would like to finance versus one which you would not want to touch with a barge pole, right? So I think on that note, we could stop here. Thank you all so much for a wonderful discussion. Thank you.
Thank you so much to all our panelists. I would now request Chairman Sir to please come on stage and present our panelists and the moderator with a memento. Ladies and gentlemen, a huge round of applause for this panel, the panelists, as well as the moderator.